Good morning. Welcome to Mornings with Michael. This is Sunday. Hope everybody is having a great day. Um, this is where we ended up on Friday, and pretty interesting. This company, FinViz, now has a crypto map, and I'm just going to bring it up here. I guess it didn't quite come up. I'm going to pause for a second, see if I can bring that up for you. I guess I did not pause that. So here's our crypto map. Just kind of shows you where the heat is. And most of the heat has been and remains in Ethereum. I saw a report that somebody was uh, predicting that Ethereum is going to go to 30,000. So that is kind of the heat map. XRP is kind of hot, and I got a pretty interesting chart I'm going to share with everybody. So that is that one. I'm going to reshare something. So if you're getting close to retirement and you don't want, a lot of people are saying the market is extended, and I'll show you some charts and analysis a little later that really kind of go over that, where we compare to 2000 and to 2008. But in 2008, the market retreated 54%. If you don't want that happen to your 401k or your retirement funds, this is a good place to be. It beats index investing by 5% per year, 12.58% to 7.57. Goes up when the market goes up, stays stationary when the market goes down, goes up again when the market goes up, stays stationary when the market goes down, and goes up again. So this is how it maintains and keeps your money. So we're going to go look at some charts first before we go to our PowerPoint and our word of the day. Here's our charts. So shift four payments looks actually pretty good for me. And this is used in a lot of hotels and some restaurants as well. And yes, it is. Looks like it's going to be in the pivot zone here. We got a little good volume right over here. And only danger is earnings are in 12 days. Earnings are down 4% this year, supposed to be up 22% next year. We'll just take a look at where the markets went off. We got the Dow Jones pullback 0.4%, IWM pullback 0.71%, the NASDAQ pretty steady, equal weight in the NASDAQ, off about the same. S&P 500 is pretty flat, and the equal weight in the S&P 500 they're all about the same here. So I'm going to take a look at some issues I'm not sure if you knew about. This is a 2x Palantir. Palantir is one of the leading stocks in the market. So it goes up 2x the amount that really 1 3/4 of the amount of Palantir goes up. We saw XRP was kind of leading in cryptos. Well, here's an ETF that does 2 times XRP. It's quite extended. It's got 2 gaps here. I'm not sure if it'll fill those gaps, but it was up 7.39% on Friday after being up a huge amount the previous day. So if you really look at the low down here to up here, this is a triple. Not too often you can get a triple on your returns. And we take a look at ETH. ETH has gone up about 30% from the low here. But if you look down here from the low, from 12 to 24 is a double. Not quite a triple, but if it gets up to 36, it will be. So 30, that is Ethereum, the ETF. This is physical platinum. It's really been taken off. So if we take a look at platinum at a high of 90, and now it's at 130. Not quite a double, but what am I drawing? I am drawing a high tide flag. And it kind of looks like a flag to me. So we'll just see if these rare earths keep trending. This is Ethereum. The double went up 7.86%, much like XRP on Friday. This is Fundstrat's Granny. I believe this is run by Tom Lee, who jumped into Circle, the IPO. And the ARK funds become relevant again from the low 38.57, pretty close to 80. So that's pretty close to a double. Here are some other leading stocks. Coinbase has more than doubled. It's gone from 142 to almost 420. Take a look at Hood. This is Hood is another leader in the market. It's gone from 29 to about 110. So that's more than a triple. That's more starting to look like a quadruple. 4 times your money investment. And here is Circle. So Circle came public. First trading day was low of 64. Went to 208. Sold off here. And it looks like it's getting ready to take off again. It did have a big sell-off, 5% on Friday, but it is definitely something I would keep your eyes open on. Tom Lee of Fundstrat is running this. So this is MP. They signed an agreement with the government What happened? They gapped up here. So the rule is the low of the gap. If you buy here, as long as it doesn't undercut the low of the gap, you continue to hold. And what happened? It gapped up again to right here. So what is that? It's from 30 to 60, so we definitely got a double. What happens when you go up 100%? You have a high tide flag, one of the rarest stock ideas or patterns that you'll ever find. So there's your flag. There's a flagpole. And what frequently happens, it kind of consolidates over here, and then it'll go up another 100%. So that's what you're looking for in a high tide flag. And sometimes it'll go up, create another flag, and go up another 100%, creating a 300% run. So that is MP materials. And then we can go over to uranium. Typed in the wrong symbol. This is the ETF for uranium. Look where it's gone from the low 1950. So the ETF itself is doubled. What are some of those holdings in there? I like to go to the biggest fish in the uranium is Cameco. It's gone from 35 to 80. So that's a little more than a double. And then I go to Denison Mines, one of the smaller fishes, and it's done more than double here. Gone from 108 to 214. And we can take a look at UU. It's gone from 320 to 936, so this is a triple. My pen stopped writing there. So that's a triple there. Not saying I should invest in it, but there are things that are taking off pretty wildly. This is another double in uranium. It's gone from 385 to over 8. And in the nuclear area, OKLO went from 742 to 73.55. It's pulled back here, and it looks like it's ready to take off again. Up 2.69% on Friday. Centrus Energy supplies low enriched uranium for commercial nuclear power plants. It's gone from 49.40 to 250. So that is a little more than a triple. It was up 6.61% on Friday. Here is one that has been retracing after its big move. Went from about 45 to 161. And it's kind of like the yo-yo effect. It's come all the way back down. This is why when you have a nice profit, it's good to take at least 2/3 off the table. And what are the rules for that? The rules for taking profits are from 20 to 25%, you take 1/3 profit. 25 to 35%, you take another third profit, and then you can let your profits run. But if you have a scary big loss of 12 to 15%, then you take the rest of your money off the table and move elsewhere. Here's another example of why you learn to take your profits. Duolingo had a nice gap up. You bought the gap up. You have another gap up right here. And this is where you learn to take your profits. And right now, it's filled the one gap. And it's coming pretty close to filling the other gap. Remember, I said 80% of gaps fill. And this is quite an example. So I'm going to stop our share here. I'm going to go over to our PowerPoint. Go to the top. So we can start out with our word of the day. So a word of the day is apiary. Word of the day is apiary. It's a noun, a place where bees are kept, a collection of beehives. So this is a pretty interesting chart. Just trying to hide my menu here. There we go. As the market continues to wrap up, the bears are continuing to move up. This is from Market Surge and Scott St. Clair right here in the background. I believe this is a AAII survey. You would think that when the market gets stronger and stronger, there'd be more bulls, but that's not the case. People maybe are reading the tea leaves, but as Scott said on his podcast, that you would think you'd wait till you have a little selling happening. So this is IWM, pulled back to the moving average here, 20-day moving average, and bounce back. And we got a little bit of selling happening on Friday. It's kind of a mixed bag because the stochastics is moving on and the CCI has a bend here. So we'll just have to continue to watch that. It may not happen immediately, but I think this is eventually going to pull back to the moving average here. This is the NASDAQ. Got a stronger sell signal here. We're a good ways away from the moving average. So those are two. Maybe I should I'll bring up our list of, I'm going to pause right here. So we're back here. This is a 7-point checklist on how you determine if you got a bearish or a bullish signal. Bullish or bearish engulfing. So the last one we were looking at, we had a bearish engulfing, bullish or bearish harami. And then you just go off and check which is which. If you have inverted hammer or a hanging man or a stale green or a stale red light. If the volume is up or down, 20-day simple moving average divergence, gaps, like we've been talking about, 80% of gaps fill, the 80-20 rule. Take a look at the stochastics overbought, oversold, CCI, and roll reversal. So if there is a divergence above or below, or I can't quite read the last one here. I'll just expand it a little bit. Is there a bounce or a breakout from role reversals? So that is kind of how we figure out which way the market's going to go. So if we look right here, we got a spinning top on the NASDAQ. Spinning top is indecisive. It needs another candle over here to really help you decide. But most times it means that there's a role reversal or there's going to be a change. And then we got a big gap up above the moving averages here. We got a higher volume selling right over here than the previous day. It looks like a flattening out, like an oversold area up here in the stochastics, and we got a slight bend here. So we do need a little bit more information, but we need to be careful because it looks like possibility the roles are changing. So the S&P 500, it's up here near highs, and it looks like we got a spinning top here as well. We're far extended from the 21-day moving average. We got declining volume, so declining interest to move it higher. We're crossing here across the oversold area, and we got a hook here on the CCI, Commodity Channel Index. And then we kind of move on to the VIX. It looks like we got an inverted hammer here on the bottom. This is an inverted hammer or indecisive. Could possibly need some more information. We almost closed this gap over here, and there was another gap that we closed right here. So we'll just see if we can move that. These are going into oversold areas right here. This looks like it's beginning to turn. So it is something to keep our eyes out on. Now here are some warning signs. This is a Buffett indicator, market cap to GDP ratio. Well, you take the total capitalization of the stock market, divide it by the GDP of the country, and take it times 100. This is given to us by Sticky Trades, which you can find on the internet. And this is our next chart. The Warren Buffett indicator has never been higher than it is now. The U.S. stock market capitalization to GDP ratio hit a record 210%. The ratio has risen a whopping 45% over the last 3 months. By comparison, the 2000 dot-com bubble peak was at 144%, and we can see that right over here. The S&P reversed a $10 trillion market cap loss, which was over here, I believe, even with a 5 trillion Mag 7 gain. The top 10 companies as a percentage of the S&P 500 market cap. And Sticky Trades has a magnificent 7 aggregate weekly chart here they prepared. And they have never seen, in all the time they've been looking at this, a gap. What do we have here? Well, we have a gap. And remember, we said 80% of the time, gaps fill. So keep an eye out on this. This is once again the Big Cap 7 weekly chart. Now, Americans primarily working full-time and second-time part-time jobs surged by 133,000 to 5.05 million, one of the highest levels in history. As a share of employment, this metric sits at 3.1%, in line with the 2008 financial crisis peak. So we go back here to 2008, and it is past the peak. So it is something to definitely watch out for. Affordability in America is rapidly declining. That's what this chart shows. And this is something brought out by another investment, Bill Smead. Bill Smead warns the stock market rally is vulnerable to be a reversal. He sees in the Nifty 50 in 1966, the dot-com bubble burst in 2000, and now he says we're at the line of death, AI bubble bust. So it could go all the way back down to here. And look at this. This one went on a 65% decline. This was a 65% decline. Interesting that they matched up. This one took 27 years to make new highs, and this took 17 years to make new highs. So it's just a little bit of a warning sign. And here is the Shiller PE ratio. It's getting up to 2000 dot-com bubble highs. So it's currently at 37.9 for the PE ratio. All the historical average is 17.6, so you can see it's quite above this average line. And Smead also cites Warren Buffett's cautious cash position as a sign of potential market trouble. And this is from Sticky Trades. This is silver. And they put a nice American flag on here just to alert you that this is a high tide flag. Here's the flagpole. Here's a waving flag in the midst. And as we said in the previous high tide flags we looked at, they often go up another 100% from where they are. And Russia is stockpiling silver to back their currency. So that is just one of the examples of what is happening out there. And we end out with our finance quote of the day, going way back in the bushel basket. The greatest wealth is being content with little, according to Plato. So that is our report this weekend. Hope everybody is having a great weekend. Go out there and do something good for the rest of society. If you see somebody struggling, try to help them. And we will see you on Monday. Have a great day.